What happens when you're in control of your finances, your career, and your well-being? There's no limit to what you can achieve. I'm your host, JaeVic, bringing you on a journey through finance, fitness, and finesse. A podcast about developing your 8 dimensions of wellness. If you're looking to elevate your wealth, well-being, and discover the power of balance, join me bi-weekly, Mondays and Fridays, to learn why money matters, but wellness counts. Hey finessers! Welcome back to another episode of More Money Mondays, where we break down the confusing financial jargon, stigmas, and assumptions to help you take control of your financial wellness. I'm JaeVic, and today we're diving into a topic that's old as time itself: loans. Yep, we're talking about borrowing money, the good, the bad, and the downright confusing. Let's get into it. So what exactly is a loan? Basically, it's a way for people to borrow money for a specific reason. The borrower promises to pay back the money they borrowed plus some extra interest over a certain period. I like to refer to this setup as the chains of debt. Researching for this episode, I found out that loans have been around for over 4,000 years. Little history lesson here for you because we need to know our roots. Around 2000 BCE, Mesopotamia farmers borrowed seeds to plant for crops in exchange for a promise to pay back when the crops started growing. This borrowing and repaying cycle was one of the first models of the loan systems we use today. Now fast forward to 2024, and loans are a huge part of modern finance. They help people and businesses get the money they need when they may not have it readily available, so they can use it for all sorts of things, from buying a home, an office space, starting a business, or one of the most popular but quickly fading out due to the high cost, going to further education. We're talking college, sometimes with trade schools, but trade is actually maybe on the up and coming now that school is not really worth the investment that it was advertised to us. With all this access to extra money comes a lot of responsibility, which is a huge issue because I don't think people really know what responsibility with money really means to them. And that's where things are getting scary. School is not panning out to have the return of investment that was advertised to us. If you aren't careful, you will find yourself paying for school to get a job, then getting a job to pay for school. And the hamster wheel keeps spinning. Today we're going to break down the different types of loans, who makes money off of them, and some key things you need to know before you take on the burden of that financial commitment. This episode isn't about scaring anyone away from taking out a loan for things like education or other needs. I want to help our lifelong learner community understand what they're getting into and how to potentially make the most of it. So, when we think about who actually gives out loans and who can make money from them, you may be thinking banks, right? And you're absolutely right, but there's definitely more to the story of who can also grant loans. Loans are offered by banks, credit unions, other financial institutions, and of course, the government. Loans can be used for many purposes, from, again, funding education, to purchasing a car, a home, or starting a small business. Banks are probably one of the first places that come to mind, at least that's how it is for me when to think of where to get a loan, but they're not the only ones out there. You've also got credit unions, consumer finance companies, online lenders, Uncle Sam, and even peer-to-peer lenders offering loans to those who qualify. I'm going to offer a few quick tips throughout the episode, and here's the first one. With the rise of online lenders in recent years, it is critical to make sure a lender is legit before committing. Hackers, fraud has been on the rise, and it's honestly it's honestly becoming a full-time job for some people, and if you're unsure about the credibility of a loan, consider checking with the Consumer Financial Protection Bureau or the Better Business Bureau. They can help you verify if a lender is trustworthy, and I'll put that link in the show notes. Earlier this week, I had a finesser message me asking about the difference between a bank and a credit union. First, thank you to that listener for reaching out and contributing to our financially literate society. To answer your question, both banks and credit unions work in similar ways but have different main goals. When you open an account and deposit money in a bank, you become a customer. Unfortunately, a bank's primary obligation is to its shareholders, not you, the customer. This means banks typically offer lower interest rates on savings and higher interest rates on loans because they're focused on maximizing profits. Psst, I see broke people. Did you know the vault at your bank is very likely not full of stacks of money? Hate to break it to you, homie, but life isn't like the movies. Banks typically keep just enough cash in their vaults to handle their anticipated transactions for the day or week. For example, small banks may only keep $50,000 or less on hand to meet customer cash needs for the week or day. Most banks use their vaults to store safety deposit boxes with old birth certificates and other memoirs customers want protected. When you sign your name on the dotted line to open an account at a bank, you're basically giving the bank permission to use your money to loan out to others. If you walked in today and asked for all your savings in cash, say 15 to 25 grand or more, depending on the bank, you might not get it right away because they don't have that much physical cash on hand. There's even a service request to order large cash withdrawals ahead of time that you would have to fill out. Big takeaway here is that the vaults are empty and your money is being used to loan out to others. Credit unions, on the other hand, are unique because they're member-owned. When you deposit money in a credit union account, you become an owner-member of the credit union. You're both a customer and an owner. Credit unions are nonprofits that aim to serve their members rather than seeking to earn a profit. This often means better savings rates, lower loan rates, and reduced fees. Banks make money from loans primarily through the interest they charge. The larger the gap between the bank's saving interest rates and loan interest rates, the more profit a bank can generate. No wonder your APY is trash. To sum up, while both banks and credit unions can offer loans, their motivation and the benefits they provide to their customers or members can be very different. As we become financially savvy, here are some basics to know about loans. This segment has important terms that you need to know to enhance your money talk, or financial fluency as I like to call it. Don't worry if you don't catch every term right away. It's totally normal to need a few listens to fully understand. When I'm listening to podcasts with financial definitions and things I really want to grasp, I rewind it or replay the episode to really absorb the concepts. When I'm playing the money game, I want to know the money language. Loans can be secured or unsecured. Secured loans are backed by collateral, for example, a car or house, which the lender can take if you don't make repayments. Unsecured loans, like personal loans or credit cards, don't require collateral but may have higher interest rates because the lender takes on more risk. This is why, if you looked at your credit card APY, it could be between 19 to 26%. The interest rate is what you pay to borrow the money. It's determined by factors like your credit score or loan term. Interest rates and fees are a big one to look out for because they make a difference in how much you pay over the life of a loan. Rates can range from around 5 to 36% depending on the lender and your credit. In general, the better your credit, the lower your interest rate will be. Be sure to understand that the longer your loan term, the more interest you're likely to pay. Another thing us finessers need to look out for are origination fees and prepayment penalties. Some lenders charge origination fees to cover the cost of processing the loan, while others utilize prepayment penalties to punish you for paying off your loan ahead of schedule. Why do they do this? Because when you pay the money early, you're denying the lenders the interest they would have otherwise earned from your extended payments. Ironic, in the land of the free, we get punished for seeking freedom. The consequences of late payments or defaulting on a loan can really mess up your financial game. If you're late, expect fees and penalties that can potentially pile up too fast to handle. Plus, your credit score can take a hit, thus slamming the door on future loans or credit cards with reasonable interest rates. If things go further south and you default, you need to brace yourself because legal action from the lender could potentially lead to wage garnishment, losing stuff you own, or worse, bankruptcy. If you're experiencing this or headed down that road, don't forget that anything is figure-outable, especially with some help. See the show notes for some resources. Before taking out a loan, please carefully consider your ability to make the required payments. This includes not only the monthly payment amount, but also the overall cost of the loan, including interest and fees. No matter what age you are, refuse to be victimized by your naiveness. Alright, now that we've talked about who grants loans and some of the basic fundamentals, let's talk about some of the most common types. Personal loans are a type of installment loan, meaning you borrow a fixed amount of money and pay it back with interest in monthly payments over a set period, such as 12 to 84 months. Personal loans can be used for almost anything, from consolidating debt to covering unexpected expenses. Consolidating debt means combining multiple debts into a single loan with a lower interest rate or more manageable repayment terms. It's like smashing all of your different types of debt into a snowball and taking it on piece by piece in more favorable conditions for you. These types of loans are popular because they often can have lower fixed interest rates than credit cards and can be funded in as little as one business day. The amounts you can borrow depend on your credit health, and unlike car loans, most personal loans are unsecured, meaning you don't need collateral for approval. Business loans are designed to help entrepreneurs and small business owners expand their operations, purchase equipment, or manage their cash flow. Another popular one are auto loans, which are used to finance the purchase of a vehicle. Just like personal loans, auto loans are usually installment loans, but they are secured when the vehicle is purchased. Secured loans mean if you default, again, default means failure to make repayments, then the lender can repossess the car. Secured means collateral. Collateral means I take your stuff if you don't pay me. Auto loans generally have lower interest rates than unsecured loans because the car acts as that collateral. Most of us have heard of mortgages, which is a loan used to purchase or maintain a house, land, or any other type of real estate. These loans are typically divided into a series of regular payments over 15 to 30 years. Mortgages allow people to own a home without paying the full price up front, which a lot of us need with how expensive the housing market is these days. So think about it. Of course your lender really wants you to live a long and healthy life to keep those payments coming over that multi-decade span of repayments. Researching for this episode introduced me to payday loans, which are short-term loans that can be used to cover unexpected expenses and are usually paid back on the borrower's next payday. They often come with very high interest rates and fees, making them a pretty costly option for borrowing money, but I've heard some people will use an emergency. Now let's talk about student loans, which we all know is a big one because many people spend decades trying to escape these chains. At the end of 2023, outstanding federal student loan debt was at $1.6 trillion, according to the Federal Reserve Bank of New York. There are two main types of student loans: federal student loans and private student loans. Federal student loans and federal parent loans are funded by the federal government and come with terms and conditions set by law. Federal loans offer many benefits such as fixed interest rates and income-driven repayment plans, which are not always offered with private loans. There are two primary types of federal loans: direct subsidized and unsubsidized. If you're a student, do you know which type yours is? I suggest you find out. Direct subsidized loans are given to students based on financial need. The government subsidizes the interest on the loan while the student is enrolled at least part-time in school. You are not charged interest on subsidized loans until you graduate. After that, you have a 6-month grace period before you need to begin making loan payments. And if your loan is deferred, you will not be charged interest during that period. Unlike subsidized loans, unsubsidized loans are available to students regardless of financial need, but the interest begins accruing once you receive the funds and continues until the loan is repaid in full. All this subsidized talk was always really hard for me to remember and made my head spin in school. But I knew I needed to figure out a way so I could keep track of which loans were accruing interest versus not while I was in school. Here's how I remembered the difference. Subsidized loan money stays the same size until after you graduate. Unsubsidized loan money grows extra costs, interest, as soon as you get it. Remember, subsidized, same. Unsubsidized, unstoppable growth. Independent students who apply for a direct loan can qualify for a higher amount of unsubsidized funds. Direct loans offer benefits like no need to pass a credit check, a low fixed interest rate, flexible repayment plans, and no penalty for prepaying the loan. But they do have some downsides such as low loan limits and the need to file a new FAFSA form every year to maintain eligibility. Private student loans are non-federal loans made by lenders such as those banks, credit unions, state agencies, or even schools. I'm here to warn or inform you that private student loans have higher interest rates and less flexible repayment options compared to federal loans generally. A big difference to know is federal student loan debt relief only applies to federal loans. That's, when examples like President Biden saying he's going to forgive all loans. That does not apply to private loans. So private loans can be more expensive and less forgiving. Time to bust it. Money myths holding you back. Myth 1. Loans are just a trap to get you into debt. Let's bust this myth right away. Loans are not always a one-way ticket to debt doom. They're actually like tools in a financial toolbox, which we're building each week you listen in to More Money Mondays, because loans can be helpful for buying a home, getting a car, or kickstarting that business. Also, sometimes we need to cover unexpected bills that are outside our emergency fund, such as medical expenses. Loans give us access to funds that we may not have up front, and it speeds up our journey to recovery from when life just happens, or to achieve financial goals such as real estate. Myth 2. You have to spend all the money your lender gives you. Not true. If your lender has given you more money than you need to pay for something like school, you don't have to spend it all. You can repay the excess as soon as you realize you don't need it. That way you won't have to pay the interest on it, you won't be tempted to spend the money, and you'll graduate with a lot less debt. It's a savvy move to only use what you need and return the rest. Another hack is to put the loan money into a high-yield savings account. You guys have heard me stress high-yield savings accounts so much, but it is the first really easy investment you can make if you are student poor, or whatever type of poor that you classify yourself as. Placing the loan money in a safe place that has an APY interest rate that outpaces the loan interest cancels out the interest rate the loan is trying to penalize you with. Work smarter, not harder, people. Myth number 3. You should wait until after you graduate to start repaying your student loans. Wrong. You need to do what's best for you and what makes the most financial sense, and if you have a little bit of room to pay, maybe you start taking that into consideration. Most students never consider making payments on their loans while they're still in school. Let's say you borrowed $10,000 with a 6% interest rate and a 10-year term. Your monthly payment would be $111, with $50 going towards interest and $61 towards principal. Principal is the initial amount of money you borrow in a loan or invest in an investment. If your loan is not subsidized, meaning the government isn't paying your interest while in school, by just paying the $50 interest each month on an unsubsidized loan that's already accruing interest, you would prevent your loan balance from growing. To simplify, here's the scenario. You take out $10,000 for school. Option A, only pay $50 in interest, and after 4 years, you'd only owe the original $10,000 in principal. Option B, you paid the full $111 of interest and principal each month, you'd only owe $7,000 at graduation. Or, most likely chosen, option C, if you paid nothing for 4 years, you'd owe more than $12,700. But hey, those bar crawls, sheen hauls, and foggy memories were worth it, bro. Myth number 4. Once you take out a loan, there's nothing more to learn about it. Wrong again. Don't stop learning about student loans until your debt is paid off. The finance world and the impact of politics or policies, laws, whatever you want to call it, is always changing. Awareness of how different types of loans work, how interest adds up, and smart strategies to pay off debt faster is an advantage. By staying in the know, you can avoid becoming another statistic, a grad who's shackled by student loans for decades of their life. Instead, you could be on track to wave goodbye to debt in a decade or less and hold your head up high as you enjoy a financially free future. Knowledge is power. Period. Alright, finessers, that's all for today's episode of You're Such a Loner. Key takeaway is that loans are tools that can help you achieve your financial goals, but they come with responsibilities and risks you need to be aware of. Understanding the types of loans, their terms, and the potential pitfalls can make all the difference in our financial wellness. If you found today's episode helpful, please share it with a friend or family member who could benefit from this knowledge as well. And don't forget to hit that subscribe button so you never miss an episode of More Money Mondays. You got questions or topics you want to know more about? Hit me up on social media or drop a comment. Until next time, I'm JaeVic, and I'll see you guys on Fitness Finesse Friday. And if you don't know, now you know. Disclaimer, this podcast is for informational purposes only and does not constitute financial or mental health advice. Always seek professional guidance tailored to your personal needs.